Good morning, and welcome to the Leap Podcast, your concise, level headed crypto market update from Leap Digital Investments. I'm Patrick Penn. It's Friday, 13th February 2026. The crypto market remains in a deep risk off phase this week, with Bitcoin dipping below 67,000 earlier and now consolidating around the mid 65,000s USD amid persistent pressure from broader equity weakness. Let's leap in. The total market cap continues to contract, reflecting amplified volatility, leverage unwinds, and classic loss aversion dynamics, where recent drawdowns dominate investor psychology and fuel reflexive selling. Ethereum and Solana have tracked the downside with sentiment firmly bearish. Bitcoin is trading around 65,774 US dollars, down about 3% in recent sessions. Positive developments include growing institutional traction, such as Morgan Stanley Capital International's approval, opening doors for more corporate Bitcoin treasuries, with on-chain signals showing accumulation patterns, including notable examples like Hyperscale Data adding to holdings. Standard Chartered maintains a long-term rebound for Bitcoin around 100,000 US dollars, underpinned by resilient ETF inflows during volatility and structural adoption trends. However, near-term catalysts lean negative. Macro headwinds from slumping US stocks combined with ETF outflows are intensifying short-term selling pressure. Ethereum sits closer to $1,923, down roughly 2.8%. A strong holder signal emerges here. Over 660 million in ETH withdrawn from exchanges in the past week points to reduced selling pressure and accumulation by committed participants. That said, bearish forecasts circulate, with some analysts eyeing a potential slide towards 1,400 if broader market weakness persists. Solana is at $76.84, down 3.5%. The Fear and Greed Index has plunged to extreme levels around 9, underscoring widespread panic selling. Key variables to watch include upcoming Fed policy signals, ETF flow trends, and any rebound in equity markets that could spark a crypto recovery. Zooming out, the near-term outlook stays bearish. Bitcoin has seen roughly 70% drawdown potential from its all-time high in some scenarios, with forced selling perhaps via insolvencies or cascading liquidations potentially driving towards balanced price zones around 40,000 US dollars. BTC has underperformed gold by about 30% so far in this cycle, though counter-trend rallies remain possible, perhaps emerging in early March. Institutional positioning reveals clear divergence. 3.5 billion in BTC was dumped across exchanges in a 20-minute window recently, with Coinbase alone handling 1.27 billion. Yet at the same time, UBS ramped up exposure to BTC ETFs by 300%, while Goldman trimmed crypto holdings by 39% but retained 2.3 billion in exposure. Trimmed but didn't exit. This split highlights differing time horizons. Short-term traders locked in losses and realized multi-million-dollar unrealized pain, while longer-term allocators buy the fear. Whales depositing 340 million to Binance at losses. Bhutan offloading BTC despite long-term conviction, and miners are under pressure. In fact, JP Morgan estimates production costs of BTC around 77,000 US dollars, while price hovers below it. This all points to loss aversion dominating over price action. This institutional divergence is creating amplified volatility. Bitcoin's brief dip under 60,000 US dollars this week cleared some derivative overhang, potentially setting a lower entry for high conviction players, even as risk assets broadly reprice in a hard money environment. On the macro front, Kevin Warsh's nomination for Fed chair, pending Senate confirmation to succeed Powell in May, he continues to introduce uncertainty. Markets are weighing his historical hawkish leanings against more flexible recent commentary on productivity driven policy, but the prevailing read is a potential tilt toward tighter liquidity that pressures speculative assets. In summary, deep risk off prevails, driven by loss aversion, macro resets, and mixed institutional signals. Near term downside risk looms, with bearish scenarios prominent, but pockets of structural resilience appear with value zones for patient capital. Markets could pivot rapidly on fresh data, policy clarity, or equity stabilization. Remain calm, stay informed. That concludes your market update for the 13th of February 2026. See YouTube and Spotify links for more information. Thank you for listening to the Leap Podcast.